Welcome back to the deep dive. I want to start today by asking you to visualize something.
Yeah.
When you open your brokerage app or you look at a chart of, say, the S&P 500 or Bitcoin or gold, what do you think you're actually looking at? I mean, really looking at.
Well, most people would say they're looking at a measurement, kind of like a thermometer for the economy.
Exactly. We have this ingrained belief that the market is a giant global calculator. It takes in billions of data points, earnings, interest rates, wars, you name it, crunches them all up, and then spits out the correct price.
The truth.
The truth. It's a machine for truth. If the line goes up, things are good. If it goes down, bad. It
Yeah.
feels objective.
It feels safe. It's basically the efficient market hypothesis, just, wrapped in a nice user interface. But the source material we're covering today, it basically takes that whole idea of the objective calculator, douses it in gasoline, and lights a match.
It really does. Today, we're unpacking a text called Model 1, Market as a Narrative Engine. And I have to say, this one really messed with my head because it argues the market is not a truth machine at all. It is, quite literally, a machine designed to manufacture stories.
It's a fundamental shift in worldview. The core premise here is that if you go into the market looking for truth, looking for the right price based on fairness or logic, you are playing a game that just doesn't exist.
A game that doesn't exist.
The market doesn't care about truth. It cares about liquidity. And to get liquidity, it needs a story.
Okay, let's pause on that word, liquidity. We hear it all the time on financial news, but let's unpack what it actually means in this context. Why does the market prioritize liquidity over truth?
Well, think about what a market is. It's not really a thing. It's a mechanism for matching buyers and sellers. If I want to sell, I need someone who disagrees with me enough to buy.
Right.
If everyone agreed on the truth, if everyone knew exactly what a stock was worth trading, would just stop. The price wouldn't move. It'd be this frozen, static deadlock.
Okay, yeah. If we both know an apple is worth exactly $1, I'm not selling for 90 cents. And you aren't buying it for $1.10.
Exactly. For the market to function, for transactions to even happen, there has to be disagreement. There has to be a difference of opinion about the future. And the narrative engine exists to manufacture that disagreement. Or maybe more accurately, to manufacture the conviction to trade.
So the market creates a story just to get us off the sidelines.
Precisely. Section 1.1 of the text dives into the psychology of this. Humans we're biologically hardwired to hate uncertainty. We despise it. If you look at a chart and it just looks like random noise, you get paralyzed. You don't click buy. You sit on your hands.
I do that all the time. If I don't understand why something is moving, I just stay out.
But the market needs you to get in. It needs volume. It needs fees. So it fills that void of uncertainty with a narrative. It gives you a why. Tech is booming because of AI, or oil is up because of a pipeline leak. The story is the bridge that allows you to cross from I don't know to I'm betting my hard-earned money on this.
It's like the market is a theater production. If the play is boring, nobody buys a ticket.
That is a perfect analogy. If the market is flat and correct, it's a boring play. Nobody trades. Volatility requires a narrative. The source material says prices move because people believe in the story. The narrative gives participants the justification they need to enter the arena.
Okay, so if the market is a narrative engine, what are the parts? What's this engine built out of? The text lists some specific mediums in section 1.2.
Oh, it's an entire industrial complex. We're talking about news reports, rating agencies, analysts, social media influencers.
And cherry-picked data. That was the one that stood out to me. Because I usually think of data as the antidote to stories. Don't tell me a story, show me the numbers. But this source argues that data is just another prop in the play.
And this leads us to what is arguably the most important distinction in the entire text. Section 1.3, the difference between information and narrative.
Before reading this, I would have used those words interchangeably. Information is the story, right?
Yeah. Not at all. And understanding this difference it's like a superpower. Information is neutral. It's raw. Narrative is framed and directed.
Can you give us a concrete example of how that works?
Sure. Let's take a raw piece of information. Company X earned $5 billion last quarter. That is a fact. It's a number. There's no emotion. It's neutral. But the market almost never presents it that way.
Right. You never see a headline that just says, Company X earned $5 billion.
Never. The headline is Company X earned $5 billion, beating expectations and signaling a new bull run. Or it's Company X earned $5 billion, but growth is slowing, disappointing investors.
So the $5 billion, that didn't change. But the frame changed completely.
Exactly. The information is the number. The narrative is how you are supposed to feel about the number. And the source argues that the market almost never presents information in its raw form. It is always packaged to elicit a specific reaction.
That is so insidious when you think about it. We think we are consuming news to get informed, but we are actually consuming a directed story designed to make us buy or sell.
And we are complicit in it. We want this story. We want to be told if it's good or bad because, again, we hate uncertainty. This all feeds into section 1.5, which is called the illusion of objectivity. We love to think charts and financial reports are objective science, like technical analysis is physics or something.
Oh, yeah. The support line held, so the stock must go up.
Right. But the text argues that objectivity in the market is a total illusion. Data is selected specifically to fit a view. Charts are like Rorschach tests. You see what the narrative wants you to see. And the analysts, they have incentives that color their output. They aren't referees, they are players in the game.
It's like when you see two people looking at the exact same graph. One sees a breakout, the other sees a breakdown. They're looking at the same lines.
Because they're projecting different narratives onto those lines. But here's where it gets really interesting, or maybe scary, depending on how you look at it. The source introduces a concept called price as a marketing tool.
This was my favorite part of the reading. It completely flipped my brain upside down. Usually, standard economics says value goes up, so price goes up. The
Yep.
price reflects the value. But the text says, no, price moves to confirm the dominant story.
Yes. Think of price not as a tag on a shelf, but as a billboard. When the price of an asset starts skyrocketing, let's say a crypto coin jumps 20% in a day, what happens to your brain?
Well, first I panic that I missed it. FOMO kicks in. Then I get curious. Then I start looking for reasons why it's going up.
Exactly. The rising price attracts new participants. It is effectively marketing the asset to them. The source argues that price movement validates the story in the trader's mind.
But let me play devil's advocate here for a second. Aren't trends real? I mean, if a company's actually making more money, the price should go up. That's not a trick. That's just economics.
Over the long term, sure, fundamentals matter over, say, 10 years. But we are talking about the market mechanism, the day-to-day, week-to-week action. And the source argues that in this time frame, price is often disconnected from value, specifically to confirm a bias. Think about it. If I tell you gold is the only safe haven, and then gold drops 5%, what do?
I doubt the story. I think you're wrong.
Right. But if I tell you that story, and gold rallies 5%,
I say, see, the story's true, and I probably buy some gold.
and that's the trap. The price movement acts as the proof for the narrative. So the market moves price in the direction of the story to suck in the maximum amount of participants. It's a self-reinforcing loop. The market creates a story, moves the price to prove it, which sucks in more people, which moves the price further
And-
until it stops.
And when it stops,
Yeah.
that's usually where the pain begins. This brings us to section 1.6 and 1.8. The dangers of believing the story. The source is pretty blunt about this. It links falling for the narrative directly to account destruction.
It does. And this is the real psychological deep dive part of the module. It discusses why a neat narrative is so dangerous for a trader's survival.
Define neat in this context. What makes a narrative neat?
A neat narrative is one that makes too much sense. It connects all the dots perfectly. Inflation is sky high, so tech stocks must crash. Or there is a supply shortage of corn, so corn futures must go up. When a story feels logically bulletproof, traders engage in what the source calls over-risk.
I've definitely felt that. You feel so sure of the outcome that you bet bigger than you normally would. You think, this can't lose. The logic is flawless.
That is the siren song. The text says narratives are the primary trigger for violating risk management rules. You ignore your stop losses because the story is good.
Ah.
You think the market is moving against me right now, but the market is wrong. My logic is right. I'll just hold on.
Oh man, the market is wrong. I'm right. That has to be the most expensive sentence in the English language.
It really is. The source has a very specific warning here. If a story makes you want to increase your position size, if it makes you want to size up, that story is dangerous. It is weaponized comfort.
Weaponized comfort. That is such a strong phrase. It's using your desire for logic and certainty against you.
And the result, as the text explicitly states, is account destruction. Because eventually the narrative shifts, the story changes, the logic breaks. And if you are married to the old story with a massive position, you get wiped out.
So this paints a pretty chaotic picture. If the market is a machine designed to trick us with stories, and price is just a marketing gimmick and the news is framed, What on earth are we supposed to do? How do we survive this?
Well, the source doesn't tell you to quit. It tells you to change your relationship with the market. It differentiates between being a consumer and an observer.
Okay, break that down for me. What is a consumer?
Most people are consumers. They eat the stories, they digest the news, they let the price dictate their emotions. They're looking for the market to tell them what to do.
And a healthy trader,
Yeah.
the observer.
A healthy trader observes the narrative. They don't buy the story. They watch how other people react to the story. It's a level of detachment. You aren't in the mosh pit. You're on the balcony looking down at it.
So instead of asking, is this news true? You ask, how is the crowd reacting to this news?
Exactly. The text advises focusing on the price reaction over the content. This is section 1.7. It doesn't matter what the news says. It matters how the price reacts to what the news says.
Can we walk through an example of that? Because I feel like that's hard to do in the moment.
Sure. Let's say a company releases a terrible earnings report. They missed revenue, guidance is down, the CEO sounds scared. That's the content. The narrative should be bearish. You expect the price to tank. But then you look at the chart and the price actually goes up on that bad news.
A consumer gets confused. They say, this makes no sense. The market is broken. The news is bad.
Exactly. But an observer says, bad news came out and the market refused to sell. That means there are no sellers left. That means the demand is stronger than the story. The observer buys the bad news because the reaction told them the truth about supply and demand.
That requires a serious lack of ego. You have to be willing to act against what feels like common sense.
You have to detach your ego from the why. You have to stop needing to understand the reason and start respecting the reality of the price. The closing argument of the source, section 1.10, is really profound here. It says, the trader's job is not to find the best story or the truth. The job is to stay alive while the stories change.
Survival first.
Survival first. The market will cycle through 1,000 stories. AI, crypto, commodities.com, housing, meme stocks. The stories come and go like seasons. The trader's only job is to protect their capital so they can play the game when the next story starts. You can't do that if you went all in on the last story because you thought it was objective truth.
It really creates a sense of liberation when you accept this, doesn't it? You don't have to be smarter than the market. You don't have to predict the future. You just have to watch the game being played and not get trampled.
It takes the pressure off. You stop trying to solve a puzzle that has no solution. There is no true price waiting to be discovered. There is just the current story, the current sentiment, and the liquidity.
I think it's important we recap the axioms of Model 1 mentioned in the text, just to sort of cement this for everyone listening. These are like the laws of physics for this narrative world.
Sure. Axiom 1, the market sells stories, not truth.
Axiom 2, price is a tool for the distribution of emotion.
I love that one. Distribution of emotion. The chart isn't moving money, it's moving fear and greed from one person to another.
And usually transferring money from the believers of the story to the creators of the liquidity.
Oof.
Yeah.
That hits home.
You know, this whole deep dive has made me realize how much time I waste trying to find the reason for a price move. I'll scour Twitter or financial news sites looking for the cause. Why did Bitcoin drop $500 today?
And you will always find one. That's the thing. The narrative engine is efficient. It will always provide a reason, even if it has to invent one after the fact.
Right. Stocks fell today because of sunspots, or stocks rose today because it's Tuesday. They'll fill in the blank.
And the healthy trader knows that the blank doesn't matter. The move matters. The risk matters. The story is just the wrapper.
This has been incredibly clarifying. I feel like I can look at a chart now without feeling the need to argue with it.
That's the goal, acceptance of the nature of the beast. It's not a calculator, it's a story machine. Don't get lost in the fiction.
So as we wrap up this deep dive into Model 1, we want to leave you with something to think about. A little homework for your brain the next time you open your trading app or check your portfolio.
Right. The source challenges us to really examine our own motivations. The next time you see a price move, maybe a big spike or a sudden crash, and you immediately go searching for the reason, just stop for a second. Ask yourself, are you genuinely looking for objective information? Or are you just shopping for a story that makes you feel comfortable with what just happened?
Are you looking for truth, or are you looking for an emotional sedative?
Because the market is more than happy to sell you that sedative, but usually it comes with a very, very high price tag.
Keep your eyes on the price, not the story. And remember, if the story feels too perfect, check your risk. Thanks for diving in with us today. We'll see you on the next one.
Stay safe out there.